Investing. It's arguably the most used financial term today because everyone has been preaching the gospel of investing for the future and letting your money work for you. As incredible as that might sound, investing can be very scary and intimidating. So if the idea of investing intimidates you, don't worry, because you're not alone. There are plenty of stories out there of people losing everything in the stock market, and these stories aren't pretty. But don't worry, we're here to help you get started on this investing journey without running the risk of losing all your money. In this video, we'll be giving you some easy to follow tips to get started on this whole investing thing while playing it safe. Number 1, you don't need $1 million to get started. When most people hear about investing, what comes to their mind is, well, that's for the rich. And they couldn't be more wrong. You don't need truckloads of money to get started investing. You can actually start investing with whatever little money you have. Yes, as little as $10 can get you on your way. However, if you'd like to gather substantial capital for investing, financial experts recommend that you start saving around 10% of your income and investing it over time. So if you make $50,000 per year, for example, try saving $5,000 each year and you'll accumulate enough capital to make your first investment. Once your money is invested, it will typically be placed in a mutual fund or exchange-traded fund, an ETF, depending on the platform you're using. Number 2, make thorough research. You can't just jump into investing without first reading up and researching what you are about to get into. From understanding finance terms to knowing which stock to invest in and when to invest in it. Research is crucial to investors. Reading books on investing and asking questions about what you're about to get into, so you're not going into it cluelessly. Stay up to date on the stock market and follow up on stocks that you want to invest in. Generally, be informed and stay informed. One of the most recommended investing books for beginners is The Intelligent Investor by Ben Graham. You can get started with that and go up from there. Remember, take your time and do your research and start off on the right foot. Investing isn't a get-rich-quick scheme. Number 3, start investing now. Another common misconception about investing is it's too early or too late to start investing. Warren Buffett is one of the most prolific investors of our time. He revealed that he started investing at the age of 9. Most of us were running around with a shiny bicycle at that age and didn't even know what stocks were. The biggest advantage to starting early is that the earlier you start investing, the more time your money has to grow. This is due to something called compound interest, which means that your invested funds earn interest, and the interest earned earns more interest for you. The longer you have to let your money grow, the more potential you have to earn a significant return on your investment. It is also never too late to start investing. In fact, the longer you wait, the more you miss out on potential growth of your money through compound interest. So don't let your fear of being late to the game hold you back. Now is the perfect time to start. Number 4, diversify your portfolio. Don't put all your eggs in one basket has never been as valid as it is when it comes to investing. Whether you're a beginner or a master investor, putting all your money in just one stock is never a good idea. Sometimes it might go your way, but more often than not, it can go horribly wrong. Invest in different types of assets, such as stocks, bonds, and real estate, as each type of investment has its own risk level, and by diversifying your portfolio, you can balance the volatility caused by any single stock or bond by going up or down too much. This can potentially help you earn higher returns in the long run. Yes, this may be less lucrative than going all in one stock, but it is significantly safer and more reasonable. Number 5. Be realistic about your expectations. Investing can be a fascinating and potentially lucrative pursuit, but it's essential to be realistic about your expectations. One common mistake many new investors make is expecting to earn massive returns overnight. You must remember investing is not a get-rich-quick scheme, and earning big from investing requires a lot of time and a lot of patience. In the world of investing, slow and steady often wins the race. Another unrealistic expectation that many people have is that they think they will be able to predict the market, and this can lead to costly mistakes and devastating disappointments. Instead of trying to outsmart the market, focus on building a diverse portfolio in a long-term investment that will align with your financial goals. Remember, investing is a marathon, not a sprint. by being realistic about your expectations and taking the long-term approach. You'll be well on your way to building a successful investment portfolio. And remember, the key to successful investing is patience and persistence. Don't get caught up in the hype or succumb to the pressure to make quick, risky decisions. Trust in your investment strategy and stay the course. Number 6, know the difference between risk and rewards. When it comes to investing, it's critical to understand the difference between risks and rewards. Every investment carries it with some risk level, whether it be the risk of losing money or the risk of not seeing the returns that you were hoping for. Either way, you do have to take some level of risk to get any reward. The key here is to find the right balance between risks and rewards that aligns with your investment goals and your level of risk tolerance. Just how much risk can you take, and how much loss can you bear if it doesn't go your way? Is the reward from the risk worth it? Consider both sides of the risk and reward will help you make a logical decision. Understanding the relationship between risk and reward enables you to make informed investment decisions that help you work towards your financial goals. Number 7, beware of fees. One of the trickiest parts of investing is the fees. There are tons of fees you'd be required to pay as an investor, from commissions to management fees and other charges, which depends on a million different things. If you're not careful and well informed, you might incur a lot of these fees, and that can claim a consumable chunk of your investment returns and reduce the overall profitability of your portfolio. It is therefore crucial that you are aware of the various fees that may be associated with your investments and understand how they can affect your returns. Some investment fees are upfront and easy to see, like commission charge whenever you buy or sell investments. However, the tricky ones are the other fees, like the management fees, which may be less transparent and can be more difficult to spot. So it's essential to do your research and understand the fee structure of any investment you're considering. This way you can make more informed decisions about where to invest your money and minimize the impact of those fees, so you don't end up giving out a massive chunk of your return as fees. Bonus tip! Here's a bonus tip for you beginner investors. Always seek the advice and guidance of a seasoned investor or financial advisor. These guys are way more experienced in investing, and their wisdom nuggets would go a long way in making your investment journey smoother and more manageable. The first step to doing that is subscribing to our channel and staying tuned for updates. Trust us to give you the best financial advice. We hope these tips have been helpful for you as a beginner investor. Investing doesn't have to be this complicated or scary thing, and it can be a smart way to grow your wealth over time. Tell us what you think down in the comment section below, and hit that like button and subscribe button so that you don't miss out on any of our amazing content. We wish you the best on your investing journey.